Assalamualaikum and hello. My name is Nurhaliza binti Norjani, matric number BB2211023. This video is about the difference between Islamic banks financing and conventional bank loans. Conventional banking makes deposit and individuals and more to business account and provide loans to individuals needing financial assistance. Deposit money into a conventional accounts allow the individual to receive interest on money not being used, and they have the opportunity to qualify for a loan such as purchasing a car. Finance Islamic banking is a kind of financial service allowing the use of profit sharing such as interest-free Islamic loans and other financial service based on the guideline provided by Islamic Sharia law. Let's see some major difference between Islamic banking financing and conventional banking. Interest rate. Islamic banking is based on Islamic or Muslim law principle, which is prohibit lending money with interest but promote risk sharing. Conventional banking more to operate on traditional financial transaction, including interest rates. Profit and loss sharing. Islamic banking by profit and loss shared by the bank and the customer, while the conventional banking, the bank makes money on loan and pay interest on deposit. For risk and sharing, Islamic banking the risk is shared by the Islamic bank and the customer. Conventional banking, only the customer bears the risk. That means the risk will not sharing between the customer and conventional banking. Restriction on investment. Islamic banking investment in industry considered haram are forbidden, such as items like include alcohol. No restriction are imposed in conventional banking. Islamic banking, the cost of the Islamic financial product is linked to an asset or commodity. For conventional banking, pricing is based on current interest rate. Government loans. Islamic banking, the government cannot obtain loans from the monetary agency without ensuring the delivery of goods to the National Investment Fund. For conventional banking, the government can obtain loans from the central bank very easily through many money market operations without initiating capital development expenditure. Economic growth. Islamic banking, due to the multiplier effect, real wealth grows among the people of the society and becomes the property of many hands. For conventional banking, real growth of wealth does not take place as the money remains in the few hands. For effect on GDP, Islamic banking, due to the increase in the real GDP, net export become positive. This reduces the burden of foreign debt and local currency becomes stronger. For conventional banking, due to a decrease in the real GDP, the net export amount becomes negative, and this invites further foreign debt and the local currency become weak. Time value of money. Islamic banking, profit on the exchange of goods and service is the basis for earning profit. For the conventional banking, time value is the basis for charging interest on capital. Business loans. Islamic banking, loss in share when the organization suffer loss. Conventional banking, interest is charged even if the organization suffer loss. Thus, there is no concept of sharing loss. Exchange of goods. Islamic banking executing agreement for the exchange for goods and service is a must when disbursing funds under Muharaba, Salam, and Istisna contract. Inflation. Islamic banking, due to the existence of goods and service, money does not expand in and thus no inflation is created. Due to control over inflation, the entrepreneur charges no extra price. And for conventional banking, due to the non-existence of goods and service behind the money, while disbursing funds, money expands, which create inflation. Due to inflation, the entrepreneur increase the price of his goods and service, incorporating the inflationary effect into the cost of the product. That's all from me. Thank you.